Hello, Merck members. Thank you for joining. Today, we're going to have a webinar on the mortgage market. A lot of things have changed with mortgages over the last couple of years. And we have with us today one of our mortgage brokers, Patrick Wade, who's on the ground every day dealing with members and their mortgages and their questions and what the market looks like. So good morning, Pat.
Good morning, Paul. Thanks for having me.
Absolutely. So, Pat, you know, the mortgage, it's one of the biggest purchases, obviously, a consumer will make in their lives. And there's a lot that goes into it, first from finding the home to choosing the right mortgage product. I know the market has changed a little bit. We've been in a very low rate environment for the last couple of years, and people have been accustomed to getting 30-year mortgages 3% or below 3%. First of all, tell us about the rate environment now. Has it changed a little bit?
You know, Paul, it historically, the rates are still very low. In the last couple months, it's definitely, there's more fluctuations in the interest rate.
Right.
You know, typically, you had more stability each day when you would see the rates come out at 10 a.m. Right now, there's fluctuation. Though the rates are still low, they are moving more frequently than they have in the last few months.
So, Pat, if I'm a consumer today, do I just want to look at the 30-year fixed? Are there other options today that I might want to consider, balancing that out with how long I expect to be in the home? What do you think consumers should really be weighing when they're looking at terms of a mortgage?
Yeah, it's interesting. Most people will only consider fixed rate loans. And that's been true as long as I've been in the industry, and that's for 20 years. Often that's the right choice. You know, it's the most popular loan is a fixed rate loan. The 30-year fix is the most popular loan. But what I would ask potential homeowners to consider is to make a comparison, right? Do an analysis based on their personal situation, because mortgage lending is not one size fits all by any means. And often when you take a couple of products and make a comparison based on some basic questions in your personal life, that'll lead you to the right program. An example I would give you is the most popular loan, you know, as long as I've been doing this, is the 30-year fixed loan. In today's market, that 30-year fixed loan is likely going to be at 4%. Another product I would ask you to consider to make sure that's the right product is a fixed product over the same amortization, so the same amount of payments, 360 payments as the 30-year fixed, but fixed for 10 years. That product's available today at 3%, so a full percentage difference. To highlight what that really means in terms of cash flow, the average loan amount for Merck employees members for their first mortgages is $525,000. If they take a 30-year fixed loan at the market rate of 4% today, their payment is $2,506. If they compare that to a 10-6 ARM, which has the same amortization, a 30-year amortization, fixed for the first 10 years, at 3%, their payment would be $2,213, which is about $300 difference less that they'd have to pay.
Sure, that's powerful.
That's very powerful.
So, Pat, explain to the members. So, for 10 years, you're fixed for 10 years. No matter what happens with the rate environment, 10 years you are locked in this example, at that 3%.
Correct.
Then after that, what happens? What is the 6? Then it readjusts every 6 months?
Every 6 months, there could be a change in your interest rate, but it has caps, Paul, so that you know that it can't go above a certain threshold.
Right.
And you have 120 payments prior to that, 10 years at 3%. So if your financial planning and your assessment tells you that in month 121 that you wouldn't like the adjustment, you could refinance at that time. Given that time period of saving $300 a month for 120 months, you've saved $36,000.
Sure.
Of which you could pay down your unpaid principal balance on your existing loan. And so that when you went to go to market to refinance, your balance would be much lower.
Right. Absolutely. So, Pat, the other aspect of mortgage borrowing that turns consumers off is all the paperwork and things that you have to get together to get the mortgage going, right? It's a lot more than a credit card, an auto loan. Can you speak to that today? What does that look like? What should a consumer expect as they're getting ready to prepare for providing the mortgage broker all the information they need?
Yeah, Paul, that's a great point. Unfortunately, all lenders aren't equal. So what I would ask your membership to do is consider, at the beginning of the process, some pretty straightforward questions. They want to think about questions in terms of their lender are they able to meet deadlines? Is the lender going to be able to meet the member's agreement of sale, close on time?
Sure.
How much communication should the member expect throughout the process, and how is that going to take place? On a personal level, I prefer the phone. Is the lender going to adhere to that, or are they going to try and just simply email to me?
Right.
I'd want to know if the lender is going to, sell their loans, or are they going to hold them?
Right.
Is my payment going to go somewhere else? And if I have a question, who do I call?
Right.
These questions are likely going to determine, if you want to work with that lender. And some of the more detailed questions you would then want to follow up with the lender are, what fees are associated with my loan? What programs are going to be available to me? Lenders typically have a set fee structure and set loan programs. So there's not a lot of flexibility there. I would say the exception to that would be the credit union world, and certainly a credit union like Merck Employees Federal Credit Union, who I've worked with, for the past 7 years. Merck has tremendous flexibility in both fees and programs.
Right.
Just this past year, and I'm sure you're aware, Merck saved their members over $250,000 in lender fees. Just to put that in perspective, that's based on your volume. That's over $2,500 per member per loan. That's significant.
Right, and that's a challenging thing for the consumer, though, Pat. We try to express this to members. They just look at rate, and you have to look at the rate, obviously, but there's a lot of fees that are behind that I think are hard sometimes for the member to really figure out, right? What's the best way for them to get a handle on the fees?
So you're going to ask up front as a member, you're going to see a loan estimate from each of your potential lenders. And in order to compare one loan estimate to another, on that loan estimate, you're going to look at your APR. And your APR, your annual percentage rate, is going to take into account both your actual interest rate and the fees associated to get that interest rate. And that gives the member a true comparison as to which loan is better for them.
Sure.
With the loan terms being the same, the member should choose the lower APR.
Right. Absolutely. Now, Pat, you mentioned flexibility. I think what a lot of borrowers will hear from their mortgage provider is that the loans are underwritten to Fannie and Freddie standards, right? Which is the secondary market for mortgages. Institutions like us, we have a lot of flexibility because we can certainly underwrite to Fannie and Freddie. But if somebody doesn't meet one parameter or another for whatever reason it may be, we have the flexibility to still do that mortgage. Can you speak to the power of that? Not everybody does that, correct?
Paul, that's very powerful. I'm in the business, since 2001, and at that time, and as it's true today, the largest buyer of mortgages is Fannie Mae and Freddie Mac combined, and they set the guidelines for those loans. That's very powerful. But what's more powerful are credit unions like Merck that are able to take a look at those guidelines set by Fannie and Freddie, but really make a local decision based on the membership.
Yeah.
So that gives Merck a lot of power, and it gives the member a lot of power, because there are situations where the guidelines set by Fannie and Freddie don't allow the member to move forward the way they would like to.
That's
It
right.
doesn't mean that it's not a good loan.
That's
It
right.
simply means that you have to make an adjustment. And the real way to make that adjustment is to have a local lender like Merck who knows their membership and can assist that member to be able to move forward when others can't. I mean, community banks and some of the bigger mortgage players, if you don't fit inside their lending box, you're not getting a loan. That's not true in the credit union world. And that's very powerful to the membership.
Yeah, and I like how you put that Pat, the box, because we pride ourselves on that here at the credit union. If somebody has some kind of different factor that we have to look at that doesn't fit right in that box, I mean, that's what we're here to do. We want our members to get that special service. So I think it's important for people to know that not are all created equal when it comes to mortgage providers. Some are just locked into those parameters. So, Pat,
Exactly.
I would also ask, just in the mortgage market in general, I think people are reading the headlines. Prices are through the roof. Everything's very competitive. There's, open houses have lines, people ready to buy a house. Does a member really need to be pre-qualified and ready to go before they start that search today?
Yes. So what I would advise people to do, Paul, when they start to think about home ownership, successful home ownership starts with preparation. And that actually starts even before someone makes a mortgage application. The number one thing that someone can do to prepare or even start to think about buying a home is to put together a budget.
Right.
Simple thing, but I would say the majority of the population does not do that. And
Sure.
you can do it by simply taking into account, what is the income coming into the household? What are the expenses going out? What is a comfortable payment for me, for my family to afford in order to acquire housing? I would start with putting together a simple budget and consider things like lifestyle. You have to really have an honest conversation with yourself in terms of your lifestyle. Because the reality is that when you buy a home, an initial 1 or 2 year period, you're going to spend a little more than you expect, right? You're going to want to buy furniture. You're going to want to buy, maybe change the paint color. You might need a car, things like that. These are all factors that are going to go into whether or not you're going to be a successful homeowner. And that's going to be very helpful for that member when they ultimately make a mortgage application. Because what they're going to want to do is start to think about loan programs. And if they have that budget prepared, that'll give them a more informed way of deciding which mortgage program is best for them. In
Sure.
terms of the second part of the preparation, I would ask the members to get their documents ready. I call it the rule of two. In the mortgage industry, we like to see a 2-year history of where the members lived, 2-year history of where the member worked, 2-year history of how much that member made in terms of income. Then we're going to ask for certain documentation. We're going to want to see 2 pay stubs, 2 W-2s, maybe 2 tax returns, 2 forms of ID, and 2 asset statements. That is the information that the mortgage lender is looking to verify in order to give you the member, a pre-approval letter. And in this market, Paul, where there's a lot more demand than supply of housing, if that member is going to an open house or working with a realtor and they have a pre-approval letter, which essentially is a blank check to buy that property, they stand out to the seller. And that will put them ahead of the others that simply show up and say, yeah, we're thinking about buying. That seller's not going to take them as seriously.
Right. Absolutely. That's great. Well, Pat, thanks for the great information. And I'd like to say to our members, Pat is available to speak to about your mortgage buying needs. And, one of the great things about working with the credit is really it is not a pressure situation. We want our members to be in a good situation and get the right loan that's for them, whether it's with us or somebody else. So as always, the credit is here for the membership. So Pat, appreciate your time again today and good luck and keep serving our members in a great way.
Thanks, Paul.
Thanks.
I appreciate it.
You got it.